In 2024, a married couple with $4 million in assets faces a critical decision that could determine whether their heirs receive $3, $2 million or $2, $4 million. The difference: understanding and implementing a spousal lifetime access trust, or SLAT, before 2026. Welcome back to the channel. In the next 9 minutes, I'm breaking down the exact structure the IRS allows, showing you the life insurance funding mechanism that amplifies the tax benefit, and explaining why the window to act is closing faster than most people realize. Let's start with the numbers. As of 2024, the federal estate tax exemption sits at $13, $61 million per person. That's $27, $22 million for a married couple filing jointly. But here's what keeps high net worth families up at night. On January 1, 2026, that exemption is set to drop to approximately $7 million per person, or $14 million combined. For a couple with $30 million in assets, that's potentially $16 million in taxable estates, subject to the 40% federal estate tax. We're talking about $4 million owed to the IRS, money that could have gone to children, grandchildren, or charitable causes. The SLAT strategy addresses this head-on, but it requires understanding how it works. A SLAT is an irrevocable trust that one spouse, let's call them Spouse A, creates and funds with assets during their lifetime. The critical feature: Spouse A cannot be a beneficiary of their own SLAT. Instead, Spouse B, the other spouse, has access to trust assets along with children or grandchildren. This structure accomplishes several things simultaneously. First, it removes the contributed assets from Spouse A's taxable estate. Second, it leverages the current high exemption before it sunsets. Third, when structured properly with life insurance, it can multiply the tax benefit substantially. Let me walk you through a concrete example. Sarah and Michael are both 55 years old with a combined net worth of $5 million, well above the 2026 exemption cliff for a married couple. Sarah decides to create a SLAT and funds it with $2 million from her investment portfolio. Under current rules, this $2 million gift doesn't trigger any gift tax because it falls within her $61 million lifetime exemption. The $2 million now sits in an irrevocable trust owned by neither Sarah nor Michael's estates. Michael and their adult daughter Emma are named beneficiaries. Sarah cannot touch the money, that's the trade-off, but Michael can access it if needed, and Emma eventually inherits it. Without life insurance, this is already powerful. The $2 million grows tax-free inside the trust. If it compounds at 7% annually for 20 years, it becomes $7 million. None of that growth is subject to estate tax when Sarah passes away. But here's where most advisors stop explaining and where the real wealth amplification happens. Now let's add the life insurance component. Instead of funding the SLAT with $2 million in cash or securities, Sarah funds it with $500,000, then uses the trust to purchase a $5 million life insurance policy on her life. This is called an ILIT, an irrevocable life insurance trust, which is a specialized form of SLAT. The policy is owned by the trust, not by Sarah personally. This is crucial because when Sarah passes away, the $5 million death benefit flows directly into the trust, completely estate tax-free. That $5 million never appears on her estate tax return. Let's look at the math differently. Sarah's actual contribution is $500,000. The trust owns the policy and collects a $5 million benefit. From Sarah's perspective, she's leveraged her exemption 10 times over. The $500,000 counts against her $61 million exemption. But her heirs receive $5 million tax-free instead of $3 million after a 40% estate tax. But, and this is important, there are 3 major objections and considerations that every couple needs to understand. First, the crummy letter problem. When you fund a SLAT with life insurance, you're technically making a gift to a trust that will eventually benefit others. For this gift to qualify for the annual exclusion, which lets you give $18,000 per person per year gift tax-free, beneficiaries need crummy rights. These are withdrawal rights that allow beneficiaries to take money out of the trust for a limited period, usually 30 days. Without crummy letters, your entire contribution counts against your lifetime exemption immediately. Many SLAT use crummy letters to fund policies over multiple years, stretching the tax benefit. But beneficiaries rarely exercise these rights, and the IRS knows it. There's ongoing litigation about whether crummy letters should be allowed in SLAT at all. The Tax Cuts and Jobs Act didn't explicitly eliminate them, but several tax practitioners believe future legislation might. Second, the poison SLAT issue. Remember, you cannot be a beneficiary of your own SLAT. But what if Michael, as a beneficiary, uses trust funds to pay off a mortgage on a house titled in both their names? What if the trust reimburses Sarah for an expense? Suddenly, Sarah has indirect access to trust assets, which could poison the trust and pull it back into her estate. This isn't theoretical. In asterisk you get Clark's asterisk estate case. Trust distributions that appeared to benefit the settler caused tax complications worth millions. You need sophisticated trust language, annual accountings, and disciplined administration to avoid this trap. Third, the 2026 exemption cliff cuts both ways. Yes, a SLAT created and funded now locks in your exemption at current levels, but the estate tax is deeply politically contentious. Some analysts believe Congress could extend the higher exemption beyond 2026, making the rush to execute SLAT unnecessary. Others point to the Biden administration's proposals, which would have reduced the exemption to $5 million immediately. If Congress extends the high exemption, you've locked yourself into an irrevocable trust when you might have benefited from flexibility. Irrevocable means exactly that. Barring unusual circumstances, you cannot undo it. Now let's address a counterargument that's gaining traction. Maybe you should wait and see what Congress does. Here's the analysis. If you wait until 2026 and the exemption drops, you cannot go back in time to use 2024 exemption. Exemptions are used when gifts are made, not when the return is filed. The cost of waiting, assuming a $30 million estate and a 40% tax rate, is $4 million in potential taxes. Even if you're 70% confident Congress will extend the exemption, the expected value of waiting is still negative. You're betting against 40% odds at a $4 million table. For most high net worth couples, that's not a rational gamble. Let me walk through the execution steps so you understand the timeline. Step 1. Consult an estate planning attorney who has recent SLAT experience. This isn't a DIY or online service situation. Your attorney drafts a trust document that's been reviewed by tax counsel and incorporates current IRS regulations. Step 2. Your attorney meets with your life insurance advisor to coordinate policy placement. The policy must be purchased in the trust's name from day one. You cannot transfer an existing policy into the trust within 3 years of death, or it gets pulled back into your estate anyway. Step 3. Fund the trust. This might happen all at once or in tranches using annual gifts and crummy letters. Step 4. The trust applies for and obtains the life insurance policy. Annual premium payments come from trust funds or new contributions from you. Step 5. Maintain meticulous records. File gift tax returns annually. Keep crummy withdrawal notices in the file, document any trust distributions, and have your CPA coordinate with your trust trustee. Here's a real case study from a 2023 tax journal. A couple, ages 58 and 60, with $6 million net worth, established SLAT and funded them with $4 million across 2 trusts. Each spouse created one for the other. They purchased $6 million in survivorship life insurance, a policy that pays out when the second spouse dies. The couple's actual contribution, $800,000 in premiums over 8 years. The death benefit paid to the trusts, $6 million estate tax-free. Compare that to the alternative, keeping the $4 million in their joint estate. At 40% tax, that's $6 million in taxes. The SLAT strategy converted $6 million in potential taxes into $2 million in insurance premiums, a net benefit of $400,000 to their heirs. But timing matters enormously. If you're 72 years old, a SLAT strategy might have limited benefit because life insurance premiums become prohibitively expensive, and irreversibility becomes a greater concern if your circumstances change. If you're 45 with a growing business, a SLAT is nearly ideal. You lock an exemption, while you have decades for policy cash value to grow tax-free and for your business to compound outside the reach of estate tax. Finally, let's address the wildcard. What if you become estranged from your spouse, or your spouse faces creditor issues? A SLAT funded by Spouse A with Spouse B as beneficiary means Spouse A's assets are now in Spouse B's creditor reach if the marriage deteriorates. Some couples mitigate this by creating mutual SLAT. Each spouse creates a trust for the other. Others build in provisions that allow the trustee to redirect distributions if the marriage ends. These customizations require experienced counsel. In summary, a SLAT plus life insurance strategy can shelter $400,000 to $800,000 or more from federal estate tax for $2 million to $5 million couple. It works because it removes appreciated assets from your taxable estate, while life insurance amplifies the leverage. But it only works if you act before the 2026 exemption cliff. If you structure it correctly with an experienced advisor, and if you accept the irreversibility constraint.